You watch a company crowned most innovative 6 years in a row, and then watch it become nearly worthless in 24 days. A balance sheet that looked like confidence turns out to be smoke, mirrors, and debt hidden in the wings. Stay with me, because by the end, you'll see how accounting magic built a house of cards, and why new laws and safeguards exist because of this fall. 1985, Houston and Omaha. Houston Natural Gas merges with Internorth to form Enron. Kenneth Lay takes the helm. Energy pipelines meet a bigger idea, trading the future, not just moving fuel. Early 1990s, enter Jeffrey Skilling. He pushes an asset-light strategy, trade energy like financial products. The SEC approves mark-to-market accounting for Enron's trading arm, letting future profits appear as today's earnings. On paper, deals look brilliant the day they're signed. In reality, cash hasn't arrived and risks haven't left. Earnings climb, the stock follows. Fortune calls Enron most innovative company from 1996 to 2001. Culture hardens around the number. A harsh rank and yank review forces constant outperformance. If your unit can't hit targets, you find a way or you're out. 1997, Andrew Fastow becomes CFO. Special Purpose Entities, SPEs, multiply. LJM1, LJM2, the Raptors, Chewco. The promise, move risky assets and debt off Enron's books. Keep the stock flying and the story glowing. But conflicts grow inside the fine print. The CFO is on both sides of deals through outside partnerships. If Enron's stock stays high, the hedges work on paper. If the stock falls, the hedges evaporate when you need them most. Enron builds an empire of stories. Enron Online for trading, weather derivatives, even broadband bandwidth as a market. Press releases sparkle. Internal emails worry. The gap between narrative and numbers widens by the quarter. 2000-2001, California's energy crisis explodes. Rolling blackouts enter the news. Recorded trader chatter later paints an ugly picture of strategies that gamed the grid. Policy and markets both under strain. Inside Enron, pressure intensifies. Deals are revalued, moved, and wrapped to hit guidance. Equity is propped up by related party magic. Losses disappear into partnerships with friendly names. August 2001. Jeff Skilling resigns as CEO after just 6 months in the top job. He cites personal reasons. Questions multiply. Sharon Watkins, a VP, warns Ken Lay in a memo about an elaborate accounting hoax. The alarm is internal, specific, and soon impossible to ignore. October 16, 2001, Enron announces a $618 million quarterly loss and a $1.2 billion hit to shareholder equity tied to those related party structures. Markets do what markets do when trust cracks. The stock slides, lenders call, confidence drains like a battery. November, the SEC opens a formal inquiry. Arthur Andersen, Enron's auditor, faces scrutiny for document shredding. A lifeline appears. Dinnigy proposes a rescue merger and then vanishes as the numbers refuse to add up. December 2, 2001, Enron files for Chapter 11. The once 60-plus stock trades for pennies. Thousands of employees see retirement savings evaporate. The brand becomes a case study in what not to do. Fallout spreads quickly. Arthur Andersen is convicted of obstruction in 2002, a ruling later overturned by the Supreme Court in 2005. But by then, the firm has collapsed. Clients flee, the brand is gone, prosecutions follow. CFO Andrew Fastow pleads guilty in 2004 and serves time. Jeffrey Skilling is convicted in 2006, his sentence later reduced. He is released years later. Kenneth Lay is convicted in 2006 but dies before sentencing. Under abatement, his convictions are vacated. These are matters of record, court filings and judgments that closed a sprawling chapter. What really broke the machine wasn't one bad quarter. It was the incentive to book tomorrow's hopes as today's profits. Mark-to-market without discipline. Off-balance sheet entities without true independence. A culture that rewarded the appearance of genius over the patience of cash flow. The fix arrived in laws and standards. 2002, Sarbanes Oxley Act passes. CEOs and CFOs must personally certify financials. Internal controls are audited under Section 404. Auditor independence rules tighten. Whistleblower protections strengthen. Accounting standards evolve to consolidate variable interest entities that used to hide in footnotes. Wall Street rewrites its checklists. Boards learn new questions to ask. What part of these earnings is cash? What sits in partnerships? What breaks if the stock falls? Simple questions with the power to puncture complex stories. Why this case still grips us is simple. It's not about energy, it's about trust. If you can't explain how you make money in 2 clear sentences, you might not be making money, just borrowing time. Enron also taught a media lesson. Admiration needs verification. Most innovative is not a moat. It's a headline that demands a footnote and a follow-up. For employees and pensioners, the costs were personal. Careers, savings, and communities absorbed the shock. For investors, it reset risk from price to principal. Is the story testable? Are the numbers durable? If you study Enron, read the primary sources, SEC filings, court records, examiners' reports. Separate the myth of masterminds from the reality of incentives. Most collapses are built from many small rationalized steps. We keep this channel respectful and ad safe. No sensationalism, just the record and what it changed. Enron's fall helped write modern corporate law, and it gave every investor a question they should ask before pressing buy. In the end, a company didn't just run out of cash. It ran out of places to hide risk. When the tide went out, the partnerships were just plywood and promises, and the market could see the nails. If careful, fact-first storytelling works for you, you're in the right place. Subscribe and keep watching. Next up, a financial fraud that fooled the world for decades, and the red flags that were visible the whole time.